Hi, it's Sunday, September the 11th, and in this video, I'm going to do a deep dive into the market indexes and sector ETFs to see if there's any opportunities for us to deploy some of our cash. We've been sitting in cash for some time and see if anything is setting up either for this week or in the next 3 or 4 weeks to come. So we'll start with the Canadian index, XIU, which is a proxy for the Toronto Stock Exchange. And we're still below the 50-week moving average. We just crossed over the 10-week moving average. So it's getting a little more interesting, but it's certainly not ready yet. One of the things I get concerned about when we're in the flat area for the moving average is that we get a situation like back here in 2020 where we come out of a small rise, then a decline, and it starts to flatten out. And you get price go, our system, if you want to call it a system, you go long when the price is above the 50-week moving average, and if it goes below, you sell. And so you get when it's flat like this, you get times when it goes above and it goes below, and it goes above, and then it goes below, and then gets above, and then goes below. So you can get shaken out a little bit. Now, if we're in that environment and we are getting in and out, generally the loss is tiny and commissions are negligible. So it's nothing really to worry about, but it does get a little frustrating. And so you tend maybe to give up, and then you miss a good move because we just haven't paying attention. But essentially, we've been in cash since April of this past year. It's interesting. I don't trade Canadian stocks in my own account. My wife's RSP is I've kept it in Canadian funds, and I just did a quick check of her trading activity from the beginning of the year, and she's only been in the market on 35 days out of the 280 days or so since the beginning of the year. So not much more than 10% of the time actually been in the market. She's currently 100% cash. And yet her account is up 5.4%. So you don't have to be invested all the time. In fact, it's very dangerous to be that way. So patience can get rewarded. So anyway, the Canadian market as a whole, getting interesting, but we got a few more weeks to go. Vanguard has a fund which is useful for any of you that only have Canadian dollars and don't want to trade in US. This is basically the S&P 500 index hedged in Canadian dollars. And you can see basically the same scenario, that the 50-week is moving down. It's getting a little more promising, but we're just not quite ready yet. Bond funds, no interest. Steeply declining 50-day. Interesting. Vanguard has a product called Vanguard Conservative ETF Portfolio. Now, conservative, I don't know what conservative means, but this is not pretty. And actually, if you measure the decline from the top down to where we are today, it's down about 13%. So, conservative. They also have a fund called growth ETFs. So growth, you would think, is more high tech, more volatile, more risky kinds of stocks. And what has that done? It's basically down the same, 14%. So, I mean, 6 of one, half a dozen the other. I don't know how they differentiate, but don't even get me started on these mutual funds. Emerging markets, down, no interest. Bitcoin, no interest. Energy, this is interesting. This one should be on the radar. We're now the 50-week moving average is trending up now. We did cross below or right at the 10-week moving average, so this is could be viable. I'd certainly put this one on the watch list. We want to try and buy it as close as we can to the 50-week moving average, but but that certainly becomes a stop area. If you bought it right here at 15.20-ish, the stop is down here at 14, so that's what, $1.20. That's too much. That's like 8 or 9%. That's too much for me. So I'd look for a tighter entry. But it does go on the list. Financials, again, are below, showing promise, but just not ready. Gold, no thank you. Information technology, no thank you. Materials, no thank you, but another month or so. Real estate, no thank you. Dividend fund, possibly, but we're in that chop zone again where the moving average is going up and now it's gone flat. I have traded this one. I traded it back here a little while ago, but didn't have it very long. It's getting, if it moves up through $20, through 2010, and then we can get a really tight stop, this one could be worthy of attention. So I'll put this one on the list. This is banks, but this is equal weighted banks. So regardless of the market cap of the 6 or 7 Canadian banks that are in this index, they're all equally weighted. Again, not much interest right now. And utilities. Utilities have been really strong, trending above the average, still staying above the 10-week moving average. Up now, last 2 weeks ago, all-time high. Quite possible. I mean, if you're very conservative, this doesn't move up or down a whole lot. I don't know what the dividend yield is, but it's worthy of having a look at. So turning to the US side of things, the spiders, we talk about these in the nightly recaps. It's just from a longer term index perspective, we're just not ready yet. QQQ, same story. Small caps, same story, getting closer. Mid caps, yeah, getting closer. This moving average is now flattened out, so it looks like more money is going into the smaller and mid-sized companies than the big, the really biggies. So, but nothing to do here yet. Then from the ETFs, this is a high yield bond fund. No, thank you. This is China E-shares. No, thank you. Blockchain. No, thank you. Natural gas. Again, I think I've talked about this before. These weekly ranges are so big. Like the last week from $89 down to 72, under 71, that's $17. I mean, that's way too spready for me. And big volatility like this means too big a risk. So even though the pattern looks okay, it's not for me. Corn has been interesting. If you like and think commodities and inflation is going to stay with us for a while. Obviously, the market thinks it is. We've got a series of 1, 2, 3, 4, 5, 6, 7 consecutive weekly higher lows. So this is definitely trending up. It's just hard for me to, if my stop is way down here at 25 and the entry price is now up at 27, you're darn near 10%. Again, that doesn't meet my risk reward parameters, but it is worthy of keeping on the list. Agricultural ETFs, same thing. We're just now starting to pop above the 50-week moving average, and the 10-week is there. When these two moving averages are extremely close together, that means volatility is tightening up, and you could get a nice, good move. So this one definitely on my list. I actually owned it. I can't remember what was about 2 or 3 weeks ago. Got a quick pop on it and then got stopped out. So, but this is on the list. This would be worthy of consideration. Commodity index, similar story, a little weaker than the agriculture. But it went below this week the moving 50 week moving average, but had a strong close at the end of the week. So again, I would put this on the list, and this might be some consideration for certainly not a full position, but something. DRV. The reason I have this on the list, this is inverse real estate ETF. So as real estate goes down, this goes up. And when I look at some of the real estate charts, I have a feeling real estate is heading down. And so this one is sort of a counter trend, if you like, but would be worthy keeping attention to. This is on my list. This one is a short of Europe. Actually, I'm going to skip by most of these next ones. This next whole bunch on my list are country ETFs. So this one's Australia, no interest. This one is Sweden, no interest, and on down. There's about 10 or 12 of these I have on my list. I just pay attention to see what's going on in other countries, and there's really nothing much of interest except for Brazil. And again, this is it's kind of choppy, but it's the only one that is right around the 50-week moving average. The Investors Business Daily has a fund for innovators. Well, forget it. Not looking very interesting. FXI, I believe, is China. Not interested. Gold producers, gold miners. No, thank you. Gold itself. No, thank you. Clean energy. Yeah, this one is of interest. And if you notice on my 15 stocks to watch, that we have Enphase on there, and we have Array Technologies. So that whole space is doing well. So if you don't want individual stocks, you could play the sector. It's getting a little extended now from the 10-week. So I think it needs a bit of a pullback here, but this one is potentially viable in the next couple of weeks. Software, no thank you. Small caps we talked about. Real estate, to me, real estate looks like a short. You got a high here, comes down, pulls back here to a lower high, down here, pulls back to a lower high, and now we're pulling back up to this 200. So to me, this looks shortable in about here. And so for a move back down this way, which is why I'm looking at the inverse ETFs, but that's probably for more advanced investors. Transportation index, mildly interesting. It needs another 2 or 3 weeks. Telecommunications, forget about it. Airlines, forget about. China again, forget about. Pot stocks, forget about. Here's one. But again, we're oil and gas. This is oil service, an ETF for the oil service industry. If I didn't have such a stupid bias against oils, this chart is worthy of because you can get in. It just crossed over the 50, so entry could be right around here at around 248. A stop, I mean, a really tight stop would be at 240. So you're risking like, I don't know, what's that, 1%, 2%? And then the real stop should be down at 227, which is, that's almost 10%. That's a little too much. But this one looks interesting. Retail, real estate retail, no thank you. Cloud computing, no thank you. Steel stocks, not really. It just doesn't have the look that I like. Semiconductors, no thank you. Social media stocks, no thank you. Now, some of you may be saying, well, wait a minute, Rick. I mean, they're really beaten down here, and we could like play this rip back up. Certainly, if that's your style, if that's your strategy, by all means, go for it. Mine, if you're paying attention to any of the charts that I'm showing you, I'm only interested in stuff that's doing this, perhaps doing this, but nothing that's doing this. But if that's your shtick, you like to do that, by all means, go ahead. I would just ask you to calculate your batting average, make sure, and if your batting average is greater than 40%, in other words, you win 40% of your trades, lose on 60, but your risk reward ratio is better than 2.5 to 1. So you're getting $2.5 for every dollar you lose. And you do that over 1,000 trades, you got my attention. You got a system that works, but it doesn't work for me. SPLG. This one is interesting only to the point of, this is basically the Standard & Poor's S&P, except you can see it's only $48. I forget which company issues this ETF, but it mirrors the S&P. And if you go back to the SPY, it's 400 and some odd dollars. So not that it makes a difference, because you are buying, or should be buying in based on dollar amounts as opposed to numbers of shares. Where are we? But the interesting thing about SPLG is the S&P pays a dividend every month, equal to whatever the average dividends are. But the SPY pays the dividend to you about 5 weeks after it's declared. SPLG pays it within 5 days. This makes a bit of a difference, especially if you're buying this and you're holding it for a year. You're compounding those dividends just a little bit much faster. But essentially, it tracks it mirror for mirror. And there's lots of liquidity in this. If I was to put an order in on Monday to buy $1 million worth of this stock, it typically has a spread of about 1 penny. And I probably wouldn't move the market more than 2 cents, 1 cent to 2 cents. So it has that much liquidity. It trades hundreds of millions of shares a day. SRS, that's short. Let's not forget that. Okay, TAN is the solar index. And again, this is up primarily because of Enphase array technologies for solar, a few names like that. I think on one hand, it needs a pullback to be viable for the longer term investors. I don't really want it to pull back because I own Enphase and I wanted to keep on going higher, but so I'm conflicted here. But this is a pretty good pattern. TLT is treasury bonds, no place to be. Oil, not terribly interesting. Uranium, this is, although we have a high, and potentially a higher high. So we'll see how it reacts over the next couple of weeks, but this is now crossed above the 40-week moving average. And so it could be viable. UUP, this is one I pay close attention to. This is the US dollar index. And as I mentioned in a previous video, as long as the dollar is getting stronger, the market's going to get weaker, generally speaking. And so the market is the dollar's had great strength in here during this market decline. But this week it's pulled back, and then the market went up this week. So just something it's not tradable for me, but it's something I do pay attention to, sort of anticipating market direction. European funds, forget it. Real estate, again, we talked about real estate earlier in a different ETF. Vanguard Value Fund, this is getting a little more interesting. It's getting close to the 200, so this will go on my list. It's not viable yet, but over the next couple of weeks, this potentially could be viable. Home builders, not yet. Materials, not yet. Communication, nope. Energy, probably, yeah. Again, it's oil and gas, it's energy. A little bit more, one more week of pullback here. This could be an interesting buy. Financials. Not yet. Industrials, close, but not yet. Worth it keeping an eye on. It's flattening out here, and so it won't take much for these moving averages to curl back up. So this is one to keep an eye on. Technology, not quite yet. Consumer staples, another one to keep an eye on. The moving average has been flat now for several weeks. So it could be poised to go higher. So it closed right at the moving averages on Friday or this past week. And so this week a move above here. And I mean, normally you'd put your stop below the previous week. So that's 74.70, say 75 to 72, $3. That's 3%. So that's, and you could even get a tighter stop if you want to put the stop under the 50-week moving average. So this is high on my radar. Utilities have been going up. They're just too extended to buy, but it's been a long, steady climb in a shitty market. Healthcare. Again, this one is getting worthy of attention too. The moving average has turned flat. So, and it's right at the two moving averages. Same thing as consumer staples. I mean, an aggressive buy could be Monday with a stop just underneath the 10-week moving average. So extremely tight stop. Could be worth a shot. This is on my radar for this coming week because I'm a little more aggressive than maybe you are. Consumer discretionary, same thing, except this has come down. I'd like this to flatten out for a little bit longer yet and then head back up. Metals and mining, same thing. It just went above. This one is probably viable. I just have to do I'd have to do the math on where the stop is, 51 down to 48. That's 250, 5%. Yeah, that's worthy of consideration. So this one would go on my list. And XRT is retail, again, no interest. So that's probably a deep dive, too deep a dive for many of you, and not enough information for some others. But that's my general approach to sector analysis. I try and do this every week, although it's not necessary. Often I'll skip a week. And for you more passive investors, doing this every 2 weeks or even once a month should be adequate, because things don't change dramatically. So that's it. That's all for that. If there's any other topics that you want me to review, by all means, send me an email, or of any particular stock symbols that you want me to do an analysis of, I'll be glad to do that. Just keep in mind I have limited data on Canadian stocks, and I certainly don't look at Canadian penny stocks. Okay, have a great week. Thank you.